Good morning, everybody. Welcome to the third in the series of the Southern California Water Coalition's What Matters. Today, we've got a really interesting, I think, special format for you. We're going to talk about money matters, infrastructure financing, and during this, the coronavirus, what does this mean to public water agencies? What does it mean to rates and a whole variety of financial issues? Before I get into that, I do want to remind everybody that is with us, we are recording. So when we complete today's program, if you give us 24, 48 hours, we will have this then posted to our website so you can share with your family and friends and others as to what we're getting into. And I also want to make sure as we begin today to let you know that if you have questions, like our other programs, we're going to go through a series of some short presentations and then get into Q&A with our guests to really kind of get into the meat of the subject. If you have a question, please go through our chat room and enter your question there. We will have microphones just because it's easier and we don't get disruptions and our broadcast to do it online. And we'll batch those questions. It will get fed to me and to Robb Grantham, and we'll ask those questions of our panelists when we get to that place. So with that little bit of housekeeping, again, I want to say thank you and welcome. I want to also thank today our web sponsors, Rich Nagel and Tetra Tech, for their very generous donations to help us with the cost to help put this together. But as we always do in all of our programs, I want to also be sure to thank our founding sponsors, the Inland Empire Utility Agency, San Bernardino County, the Los Angeles County Department of Public Works, the Los Angeles Department of Water and Power, the Irvine Ranch Water District, Metropolitan Water District of Southern California, Riverside County Flood Control, and West Basin Municipal Water District. Those are the folks that really help us drive the organization and make everything possible. So let's get into our program today. We've got about an hour or so, and so I would like to formally introduce our panelists for you, and then I'm going to hand this over to Robb Grantham, and he's going to facilitate the conversation. But to help us in our conversation, we've gathered together some of the most experienced finance experts in the municipal water market. And we have with us then today, Brian Thomas. Brian's currently serving as Executive Director of the Delta Conveyance Finance Authority. But then for those of you that know Brian, Brian has been pretty much everywhere over his 30-year career. He's led PFM as Managing Director in Los Angeles. He's worked at the Metropolitan Water District. I love the fact that he likes to vary his geography. He has worked as far east as Nevada and Las Vegas, and as far west as Honolulu. So I know that he has traversed a great deal of territory. He also today still serves as a private counselor to a variety of water agencies, both in Southern and Northern California. Also with us today is Cheryl Clary. Cheryl is the Executive Director of Finance and Administration at the Irvine Ranch Water District. She too has a varied past in both public and private sectors, where she has served as CFO for over $1 billion in privately held issues, publicly held issues. She served in Fortune 100 companies. She is steeped in both, as I said, public and private finance, and is with us today. Robb Grantham is also with us. Robb is the Santa Margarita Water District Assistant General Manager and CFO. Prior to that, Robb too had served in private sector with Carollo Business Solutions. He has extensive experience in financial issues and management analysis for water, wastewater, stormwater. If you put water and utilities in it, Robb's pretty much been a part of it. So he is with us today. And also then with us is Ted Chapman. Ted is the Senior Director at S&P Global Ratings Municipal Infrastructure Group. Ted serves as the Public Finance Team's Sector Leader and voice of S&P for the municipal utilities. He has authored their utility revenue bond ratings criteria. Yeah, try and figure that one out, which includes rating factors on affordability, resilience, and climate risk management, something that is new to portfolios for utilities. So safe to say that Ted Chapman is an expert in his role and sees a much broader area of finance and market trends. So we are welcoming Ted to our program today as well. So ladies and gentlemen, thank you all for being with us. At this point, I'd like to turn the program over to Robb Grantham, and Robb will take us through our presenters. Robb?
Thank you, Charlie. And thank you to everyone for joining, and Charlie for making this platform available. It serves as a really important point at this time with our current economy. So let's talk about our economy. The downturn was swift and broad, and it also affected different parts of our economy differently. If we look at the unemployment rate, it really has hit the low income at a disproportionate rate, and it's something that we need to address when we're looking at it from what we're doing on our side of the line as utility managers and those serving the utilities. Would you mind going to the next slide? Thank you. So we're looking at the predictions in terms of what does GDP look like over the coming year, and our panelists, Brian and Ted in particular, will be talking about this, but it's projected to be somewhere between 4 and 7% downturn, whether you're looking at the IMF or looking at BlackRock, et cetera. But we know the recovery is going to be long. It went from a V-shaped recovery to a U, to a W, to a reverse J and a swoosh. The basic answer is we don't know what's in front of us and how long it'll take us to recover. At this point, the federal government has injected in relief 10.5% of GDP, and looking at the next infusion of money. And a point of comparison, we look back to the Great Recession, it was about 5.9%. And so those liquid markets, and that's important for us in the public sector in terms of accessing money in order to build our projects. And that'll be a theme as we talk through the program. What is our responsibility as utility managers in a dual mandate? We're obligated to provide high quality and reliable service. We're also required to protect our customers. Again, addressing those that can least afford these services at this time. And finally, the sector has been, different sectors have been affected in a disproportionate manner. If we look at our small businesses, local businesses, and also commercial real estate, that recovery could be long and a sustained downturn. And so with that, I want to turn over to Brian to talk about how he's guiding his clients, i.e. The municipal agencies, through these times. And we're all looking at how can we make investments knowing that a dollar infused into an economy could have a $2 to $6 impact. But how do we get through these times when agencies are looking at deferring rate increases and looking at deferring or losing revenues? And so how can we make progress in meeting those requirements? And so Brian, I'd like to turn it over to you, please.
Well, thanks, Rob. And as we get this presentation up, thanks to all of you for taking time from your busy days to participate in this webinar. I'm going to give you a brief background on what's happened in the capital markets, and then, as Rob said, talk a bit about what we're seeing folks do to try and continue with that very important infrastructure improvements. On the next slide, I couldn't help it. Unprecedented and uncertain. How many times have we heard those words? I'm kind of tired of it, actually, but it has been unprecedented times. We're seeing, as Rob noted, highest unemployment rate since World War II. And I think the big things about uncertainty regarding large sectors of the economy and how that expands throughout the rest of the economy, both in terms of jobs, in terms of spending, in terms of how we work. One of the things that this crisis has done, it's basically accelerated changes that we've already seen starting both in good and bad ways. We've seen truly unprecedented Federal Reserve actions and the fiscal response of nearly $3 trillion with more to come, and interest rate volatility in our markets. The next slide shows what I mean by interest rate volatility. In the short-term markets, you can see in the yellow line, that's the taxable 1-month LIBOR, so short-term interest rates in the taxable market. The green line are tax-exempt markets, what we call SIFMA. And you can see they basically tracked until the middle of March, and then everybody wanted money, so they dumped their short-term municipal securities. And you can see those short-term rates spiked from about 1% to over 5%. In fact, we saw some daily rates up as high as 10%. The big thing to note, though, is on the right-hand side of the lower chart, those short-term rates have come back to where they belong at somewhere around 20 or 25 basis points, 0.2%. The next slide talks about the long-term market. We saw the very same thing in the long-term market. The blue lines here represent taxable rates, which are treasury rates, and the orange lines represent tax-exempt rates. And you can see typically tax-exempt rates are going to be lower than taxable rates. The top two lines are 30-year bonds. And you can see in the middle of March, the municipal market basically froze up. It was difficult to get any deals done. And we saw this huge, what we call dislocation, that is tax-exempt debt traded at higher interest rates than taxable. And that continues to this day, as you can see all the way to the right-hand side of this graphic. But you saw long-term rates go from like 2.5% to 3.5%. So 100 basis point increase as that market seized up. And now we're starting to see more activity and more usual activity. Next slide. In addition to that, investors are worried about the municipal market. What about those revenue decreases? What's going to happen? And as a result of that, they're asking for even more, not just the overall tax exempt market, but for different credits. This shows California general obligation bonds as they spread to that AAA tax exempt index I've been showing. And you can see back in February, basically California traded on top of that is equal to that AAA MMD rate. And now we're trading on the right side, 30, 35 basis points higher. My message here is that credit really counts. The next slide. And despite all this, this is a good time to borrow. Interest rates are still very low. And even though you can see the orange lines here are still higher than their comparable tax exempt rates, on the right-hand side, 30-year AAA MMD is about 165. Even with 50 basis points spread on top of that, you're going to be borrowing at just over 2% for 30-year money. That's still pretty cheap and still pretty attractive if you are a good credit. Next slide, please. How come this is happening? The Federal Reserve has done everything they can to ensure liquidity in the financial marketplace, and they've done it faster than ever before. If you compare to how fast they've done this compared to the financial crisis back in 2008, you can see it overnight, in fact, they created these lending facilities for corporate bonds, commercial papers, and even short-term lending in our marketplace, the municipal market lending facility. Unfortunately, that facility really doesn't have much help for water and wastewater districts. It's really focused on states, counties, and cities. And unless you work through your county or state, difficult to access that market. And it is a short-term lending facility to get through some revenue shortfalls to the extent you couldn't borrow on your own. I would say that the federal balance sheet has grown to approximately $7 trillion, mostly through purchase of treasury obligations and mortgage backs. And what that means for longer term interest rates, that's an interesting question. The Fed's going to continue to do whatever it can to support the economy, but remember, the Federal Reserve is a lender, not a spender, and so we're going to need to get the consumer working again. Next slide. What does this mean for all of us? S&P, and Ted can talk about this, but placed all of our sectors on negative outlook, including the water wastewater sector. Recent AWWA study estimated the financial impact on drinking water utilities of almost $13.9 billion, with another $1.6 billion lost due to deferred rate increases. Admittedly, this is probably on the high side. We'll see what actually happens. But in the response to the survey, utilities are talking about what they're going to have to do to meet these shortfalls. And part of it is deferring capital, and up to $5 billion of deferred capital was identified. And as Rob said, these dollars lever up in the local economy. And that AWW estimated that impact could be as much as $32 billion on an annualized basis in the local economies. Next slide. The last thing I would note is that water and wastewater utilities are strong credits. You're essential service providers. You've done great work building up your balance sheets, your reserve balances, and that liquidity is now more important than ever. Your challenges, and Cheryl and others will talk about these challenges. What about increased write-offs? How do you deal with that? What about higher costs associated with the COVID response, not just now, but into the future, implementing new work methods, whether it's work at home, micro teams, working with your bargaining units. And then lastly, and an important question is the political will of your boards and councils to raise rates and charges as we move through and come out of this crisis. The last chart I have, next slide, is what do you do for capital funding? As I've noted, cash is king. These reserves are going to help you meet your O&M costs, but pay-as-you-go capital as well. You're all keeping track of your costs so that you can get your FEMA reimbursements. There was the CARES Act passed in March 27, a couple $2 trillion worth of dollars. Again, water utilities, wastewater utilities were kind of left out of this. But there will be a potential infrastructure bill both at the state level and at the federal level, which will give us opportunities to access low-cost dollars. And I would say that you can utilize your own credit. You are strong credits for both short and long-term borrowings. We've had a couple of WIFIA loans through the federal EPA recently closed with interest rates of about 1.3% for 35-year money. SRF loans are still an attractive, although delayed oftentimes, mechanism to fund things. And then as I noted, in the public market, notes and bonds are trading at 2 to 2.5%, and you can access those to help finance your necessary projects. And with that, I'll turn it back to Rob. Thank you. Rob, I think you're muted.
I apologize. Thank you, Brian. Great overview, and it pointed to the struggles that we all have. And now I want to turn it over to Cheryl. And Cheryl's not only someone I think very highly of, she's also modest. When she was probably the first person to recommend waiving of late fees and the deferring of shutoffs. And so with that, Cheryl, would you mind walking us through how from a retail agency perspective, how you're addressing the current financial conditions?
Certainly, and thank you everyone for joining us today in such tough times. So today what I'm going to do is I'm going to walk you through it from a retail water agency perspective. How has it impacted us and what have we done about it? Next slide, please. Actually, next slide. Great. So let's talk about what we did. So we took a number of actions even before the governor issued his executive order. So as Rob mentioned, we stopped charging late fees, we stopped charging interest, we stopped shutoffs, and we put customers on payment plans for up to 12 months. If they called in, we put them on a payment plan. We have water budgets for every customer. And so there are extra people at home now. So every customer has reached out to us who says, hey, I've got more people at home. We have given them extra water usage so they're not over their water budget. And this time we've not required, normally we require extra documentation for people at home if you're over and above 4 people, but this time we have not. I think right now customer messaging is really, really important. We've spent a lot of time getting the messaging to our customers up on the website. That's particularly true because our front door is locked for our customers. Many customers are used to coming in every week and or every month, and they can't now. So customer messaging on your website is very important. And we've also used a lot of social media, things like Facebook and Instagram and Nextdoor. So I think that's very, very important to keep your customers up to date on what's going on. Next slide, please. Great, so let's talk about some of the challenges that we faced as an agency. And I split these up between short-term and long-term. So for the short term, you have difficulty estimating the full effect on the revenues and water usage and expenses. We don't know how long this pandemic is going to last, and we don't know how it's going to affect, how long it's going to affect the economy and the customers. From a long-term perspective, you may have some permanent impact on customer behavior, and you don't know what that's going to look like. You don't know how it's going to affect long-term customer water usage. And then, as Brian mentioned in his presentation, future rate increases. It's a question. What's your ability to affect a rate increase? Many of our customers are faced with job losses and economic hardships, and you want to be sensitive to your customers. And then you've got to consider the political side with your publicly elected officials. And they all want to be sensitive to our voters. So the question is, politically, could they put through and recommend a future rate increase when you have customers who are affected by economically? Next slide, please. Great. So the next thing that we did is we evaluated the budget impacts, and we split out looking at revenues and expenses. So from a revenue perspective, cash flow due to customer payment arrangements and lack of shutoff. Certainly, as of yesterday, I looked at what our numbers look like. We had about 1,100 customers out of about 110,000 customers, so about 1% who had past due balances, totaling about $370,000. Certainly not as significant as what some of the cities are facing with lost revenue from sales taxes, but still significant, and that leaves a hole in your budget. Sensitivity to pass through planned rate increases. We talked about this before. We had a $4.6 million revenue increase in our next year's budget. And again, politically, can you pass that through, or is it time to say, you know what, probably not appropriate to pass through that rate increase? Lower interest on investments, I think that goes without saying. Lower connection fees due to economic slowdown. We use our connection fees to part of them to pay for new capital. So we've seen some holes in reductions in lower connection fees. And then all of this is somewhat mitigated by how we set up our rate structure, which is our separation of our fixed and our variable rate components. I think it's really important because what this means is water usage goes up and down. We are still able to cover our fixed costs based on how we structure our rates. And if you haven't structured your rates like that, you might take a look at that. You need to make sure you can still cover your fixed cost. On the expense side, next slide, please. On the expense side, we had unanticipated purchases. It's interesting, this certainly has driven a lot of agencies to consider moving to laptop computers if they haven't already. We had some, but we still had many people here who were on desktops. And the question is, how do you work from home if you have a desktop? And in fact, what happened at our agency is we had many people actually come in. We had the IT department very busy, as you can well imagine, and people came in and took home their desktops. The real challenge will be, we're going to need to transition even more to laptops, because as they start returning and they may work at home part-time and come into the office part-time, you can't have them walking back and forth with their desktop. So really encouraging moving to laptop computers. It's it's important, but it's also challenging because when we needed to buy laptop computers, there weren't a lot available because other people were buying laptops as well. Additional expenses for PPE, of course, masks, gloves, and hand sanitizers, etc. Cleaning, we added additional janitorial services to make sure that they were coming in more often and cleaning the facilities. Staffing availability. You have some people who are not available to do their work. Some are sick, some are at risk. They can't come into the office. They may or may not have a computer. They may have childcare issues. It's particularly challenging for those people who have young people. Whoever thought that part of their job would be also to be the teacher. So challenging for a bunch of additional people. Additional vehicles due to social distancing. We used to have 2 people go out in a vehicle to some of our sites for repairs, etc. And now we have 1 person per vehicle. So they'd get in individual vehicles and they'd have to drive to the sites to fix the pipes or whatever. And then there's the expense of additional new office layouts for staff return, looking at purchasing plexiglass. All of these are additional expenses that were not in our budget. On the other side, however, there were some pass-through costs by third-party agencies, and some of the agencies have notified us that they are not going to pass through previously planned rate increases. So what do these two scenarios mean in terms of revenue and expenses? What it meant is it leaves us with a hole in our operating budget of about $3.5 million. The question is, now what are you going to do about that hole? Next slide, please. Great. So here are some possible solutions. These, of course, are not mutually exclusive. You have a reserve fund. This might be a good time to consider using it. FEMA reimbursement, Brian talked about it. You got to track your expenses. Who knows if it will be available? There's so much need out there. I think FEMA is going to be challenged, and some agencies may end up not getting FEMA reimbursement. And Brian specifically talked about the last two items, government loan programs and debt financing. Government loan programs, things like WIFIA and SRF, et cetera. And debt financing, this is a great time to go out there and go into the public markets. What did IRWD choose to use? Well, we decided to use our reserves, $3.5 million. We have something called a replacement fund. When it's one of the eligible uses under our policy, we use it for rate stabilization when there's a shortfall in terms of revenues. And we actually went to our board on Monday night and got approval to use the replacement fund to the tune of about $3.5 million. That's it. Thank you.
Great. Sorry, I just had to get it back off of mute. Great. Thank you, Cheryl. So Cheryl, one of the things that you highlight is the late payments and the increase in those late payments. You've done such a great job with your customers, yet, you know, like SMWD, we're fairly fortunate in terms of our customer base and the affordability perspective
Right.
of our customer base. You know, one of the challenges that as we were talking about the other day, if we look across just the county lines, looking at the friends on the call from LA, Scott from Monte Vista, Laura from Eastern, they have a completely different customer base,
Yeah.
and affordability means a completely different thing. So with that, I'll transition. I'm going to be filling in for Dr. Theodora. So Manny is a good friend of ours. He has been working on the national level, looking at affordability. And as Manny would say, affordability is not measured by averages. And affordability really needs to be looked at on the individual customer base. And so I'm going to share a little bit about what we're doing at Santa Margarita with the guidance of our board of directors and our general manager, really trying to forge a path that meets our financial needs, but also it balances what our customers' needs are at this point in time. And oh, by the way, Cheryl, Director Withers did take full credit for every wonderful thing we've done.
Perfect.
And so one of the other things that, Cheryl, you noted is that balance with Prop 218. So we in California have a different regulation relative to the other 49 states in terms of Prop 218. We are not permitted to subsidize customers. We need to show a cost relationship. But for some of those special districts in particular that have property taxes, we do have some flexibility. So if you don't, Nicoletta, if you don't mind forwarding the slide, I'm going to start with just talking about, you know, our dual mandate to provide high quality and reliable water and wastewater service, but do so at an affordable price. And again, that affordability can't be measured in averages. Would you mind advancing the next slide, please? So I think Jim Leach is on the call. So Jim is our head of external affairs and has worked across many sectors, including telecommunications. And so we conducted a high-level survey of our customer base and said, you know, how are these economic conditions affecting you? And what you can see, just working our way across from top left to right, do you know anyone that's been affected? Are your friends and family struggling? About half of our customers say yes. And so there's two ways of interpreting. Wow, that's great. You know, only half of our customers are impacted, or wow, half of our customers are already impacted. And then the following questions down below. Would you participate in a customer assistance program? We didn't define what that meant, but the terminology, well, customer assistance, well, maybe. So a third of our customers said, yeah, I'd participate. Now the question is how much? And looking at what is the need amongst our constituents and looking at the figures, you know, really, I need up to 3 months break in terms of my ability to pay my bill. So then that drove our discussion internally in terms of what our options were and what best option suits our customers at this point in time and balances our financial needs, trying to maintain our stability. And as Brian's helping us go present to TED, go borrow money in these markets right now. The next slide, please. So we looked at affordability and trying to help our constituents in 3 different ways. One, do we just decrease rates? And so Cheryl noted that many agencies right now are, you know, really looking at waiving or deferring upcoming rate increases. Some agencies are actually moving forward, but many, even if they had them on the books, are deferring them. But the question is, well, should we just cut rates right now? Should we give a little bit of relief? Should we give a bill credit? So as we look at insurance companies, other cable companies, even the power utilities, giving credits. Does that help our customers? And then finally, an assistance program. Can we be more targeted? So I'll be brief in talking about those three programs. Next slide, please. So a rate decrease. We're collecting a certain amount of money. Should we just decrease rates by 3%? It sounds great. It has a nice ring when talking with our constituents. But in discussion, we realize it really doesn't have the intended impact that we're looking for. If your bill is $50 and I give you a $1.50 break on it, and you couldn't afford your $50 bill to begin with, a $1.50 break really isn't going to do much. And what it also does from our perspective in terms of running the utility is it creates a financial hole that we need to recover. We either, and most likely, go through a new Prop 218 process to reinstate those rates. Next slide, please. So moving from the idea of a rate decrease, well, can we do it as a one-time credit? Can we say, well, we know $1.50 each month for 12 months really doesn't quite get us there. Can we just give you a break? And so as we walk into June, can we say, you know what, we're going to give you $20 or $40 off your bill, and then we can, then that will really help. Well, again, I've seen this a couple times before joining the district. I'd worked with 200 agencies throughout the country, and I've seen, and it's double-edged sword. It's thank you, I needed that, and then, well, if you had the money, you could give it back. Why'd you have it to begin with? And so, and for, when you look at that, going back to that survey, not every customer is struggling the same way. So if we do an across-the-board system-wide credit, it may not be promoting or protecting the customers we're trying to really address. And so that led us to our final option. And that, if you don't mind forwarding the slide, and that was, could we have an assistance program? We're really targeting those that need the assistance. And, it's interesting. Our new head of customer service, she came from an area that had a very high, low-income population. And, so our numbers are very low, relatively speaking. And one of our board members suggested, why don't we give a 1-month deferral and pay it over 12 months? And her comment was great. So we already have a program in place. I said, yeah, but we're dealing with a different customer, not just a customer that's typically struggling, but one that's never been in this financial position before, that pride doesn't want to call in and say, I need help. And so what we instead looked at is a program where someone could just sign up, no questions asked, and then pay their bill over time. And so that's what we opted for. We implemented a 1-month deferral, and now we're looking at a new program that will actually extend that a little bit further. And so with that, the final slide, please. And so our draft assistance program, which we're working with the board right now on, is, can we provide some assistance for targeted people within our customer base? It's not a giveaway. It's effectively a loan. What it allows customers to do is take a certain amount of their bills, 3 months, defer, and then pay back over 24 months if you're a residential customer. Apartment is available to all customer classes, apartment complexes, commercial, irrigation. And what we discovered through the process was, even the apartment complexes, if a tenant isn't able to pay their bill, they're actually not, their rent, they're not only deferring their rent, they're also deferring their utilities. And so they're already serving their customers, but our customer record is the apartment complex. So can we provide them something as they take on this financial burden in order to help? We're not sure how many customers will actually take us up on the offer, but we are looking at this type of program, again, to continue to support our customers. And with that, I'm going to turn it over to Ted. And so Ted, you're in this unique situation, and I, as you go through your presentation, if you wouldn't mind highlighting the different conversations you've had with your clients, i.e. us. So some of us are in a strong financial position, some of us aren't. And so we come in and, hey, Ted, I want to borrow money. How do I get the highest rating? So as Brian says, looking at the curve, I want a strong rating to borrow the lowest cost. versus the others that are coming in saying, I don't think I'm going to make my bond coverage this year. What can I do?
Very good. So just, I guess maybe to preface my remarks, I'm a 20-year recovering utility practitioner. Once upon a time, I was a budget guy for a water utility myself. So I recognize that what I'm about to say probably reinforces the view that many of you have of rating agencies. But it's a little bit of what Brian and Cheryl said of like, yeah, what they said. And before you go, well, thanks, Captain Obvious. If you can go to the next slide, please. This slide is busy on purpose. I recognize, you know, there's a ton of numbers on there. The ones that I really wanted to highlight are highlighted, obviously. Thank you, Captain Obvious. But it just shows the profundity of, you know, again, we all hate the word unprecedented. I mean, that got old by about the last week of March. But there's never been anything like this. And this came from our chief economist from her most recent update. And this is sort of the baseline scenario. If you look at the estimated, you know, projections for remainder of this year and then the next couple of years, you don't want to see the pessimistic projections, but it's suffice to say that if you go to the next slide, that probably displays it a little bit more clearly. The numbers actually came out today. There was another 2 million people that filed for unemployment. So we're up to over 40 million people that now don't have a job, either temporarily or possibly that job is gone and will never come back. So we have essentially wiped out 25 years worth of jobs. And for those of you that maybe have substantial small commercial customers, those are probably going to be the ones that are most likely to be impacted. You can see on the right, and this is something that came out last week, if you ever want to go down the rabbit hole, look at all the charts and graphs that economists produce, because there's some pretty neat stuff on there. People are getting out of the house, sort of, but they're not really utilizing anything other than just the grocery shop, you know, the grocery store quick run to get stuff. And I'm in Texas, by the way, so I mean, my lockdown rules are a little bit different than those that you are dealing with right now. But it just goes to show that, you know, regardless of the shape, whether it's kind of that Nike swoosh or whether it's a little bit sawtooth, I mean, I know that we're all becoming fans now of big pharma. Who would have ever thought that? But it is going to be at least a couple of years, according to our current projections at least, before we're even back to where we were pre-pandemic, a couple of years. And I'm talking like GDP, unemployment. And so if you look big picture, like one of the things that we looked at when we revised our rating bond criteria back in 2016 was we said, well, yeah, there's sort of that traditional rule of thumb that everyone in the industry has sort of bastardized and said, well, what's the bill as a percent of incomes? It was only ever meant to be a rule of thumb, and even then only for like a certain type of, you know, basically small rural economically disadvantaged utility. And we've just said, well, let's apply that to everybody. Well, sort of yes and sort of no. S&P since 2016 has been looking at the bill as a percent of income, but we said that's too one-dimensional. That is not enough. What happens if there is a service territory, a service area that has a disproportionately unfavorable poverty levels? So that's actually the second dimension, or the second layer that we look at. And if that sounds at all familiar, if you saw AWWA, WEF, I think NACWA contributed a white paper to EPA last year that said, you know, this rule of thumb that you've been using since like the 1990s isn't enough. You should also consider poverty. It's very self-serving for me to say that we came out with that 3 years ahead, but we figured if there is ever a situation where you, the staff, the general manager, the CEO, the director of the utility department is pitching a rate increase to council, to your board, is there ever the potential that the board says, I understand that? In a normal world, maybe it's because it's an election year, but given what's going on right now, perhaps it's just, you know what, there are folks that because of all of these graphs that I'm beating you over the head with that are worried about, I don't know if I'm going to be able to pay the rent. I have a real food scarcity problem. Because I think I read about a week or so ago of the people that are unemployed right now, 4 out of 10 are worried about running out of food by the end of the month. So this moratorium on shutoffs and disconnects, the customer assistance programs, I don't doubt that there are going to be certain segments in certain communities where it's going to be really heavily utilized. And because of that, because you're a decision maker, you could very easily say to that general manager or to the department head, I get what you're saying. I don't disagree with it for the financial integrity purposes, but most of all for the system reinvestment needs. But this isn't the right time to ask that of our customers. They're struggling, they're hurting, they're really scared about bigger picture stuff. So how about if you maybe come up with some budget cuts, maybe defer some things, and come back to us in a year or two, whenever it is that we're under normal conditions. And I hope it's not a new normal. I think we all hope that it's the normal that we all know and love. But we don't know when that is going to be. S&P has said hopefully things will start turning around like in the late third quarter of this year, like maybe around September-ish. But you know, again, that's assuming that there's not like a second wave and a whole other round of shelter in place. So it's really hard to be a decision maker right now, other than the fact that you know that you're going to have some revenue volatility. Now, from our perspective, and having been a budget person at a utility myself, most utilities in most parts of the country, again, Captain Obvious, you're going to get most of your revenues, or a disproportionately large share of your revenues, between Memorial Day and Labor Day. Good old outdoor watering. Whether you have water conservation mandates or suggestions, that's still going to be a big spike in your revenue curve. So let's say that it's mild, it's rainy, and I know that that's sort of the opposite of what's going on in California generally, especially right now, you're heading back into a drought. But let's just say that you have an unfavorable variance to budget because of weather, and it's almost always because of weather. So you're sort of shrugging your shoulders and saying, we're used to revenue volatility. That's no big deal. You know, it happens from time to time. Sometimes we kill it versus budget. Sometimes we don't hit it versus budget. So in any one particular year, from a rating agency perspective, we're sort of like, all right, I'm not necessarily saying you get a free pass, but the context in which you miss your revenues, miss your budget is understandable. It's sort of, where do things go after that? So if you could go to the next slide, please. So what S&P is looking at is sort of bifurcated. There's the right now. And you actually have, I mean, as much as you all love Prop 218 and going through all of the things that you need to do to get a rate adjustment into place, if you are affiliated with the city, it actually does offer you some protection because you have that built-in cost of service, and cities in other states can say, oh, you've got that surplus net revenue flow, that cash flow sitting there, and we've got this big budget gap. Our sales tax revenues, because of shelter in place, have just fallen, like cratered. And that has happened a lot in a lot of places. I apologize for the dogs. One of the other things that could happen is that in addition to plugging that gap from surplus net revenues, the city general government could say, oh, you've got reserves, cash reserves sitting there, and you're not deploying them for utility purposes. Why don't we get our hands on that? So obviously you have that level of protection. Could the city general government say, well, how about an interfund loan? Well, we'll pay you back. Yeah, they could go through some hoops and probably still make that happen. So your protections from like an immediate run on the bank, there are some protections, and they're pretty decent compared to other states. But there is going to be some revenue softness. I think in the bigger picture, when we look at a rating, at least our criteria says, all right, yeah, we look at the traditional financial metrics, cash flow, cash reserves, level of indebtedness. That is literally only half of what I'm looking at. The other half of what I'm looking at is the operational stuff. You're going to get basically 100% of your revenues from customers. You don't have to worry about state shared revenues getting cut or property taxes. It's all coming from rates and charges. But the flip side of that is it all comes from rates and charges. So if those drop off, then there's going to be a softness to your revenue stream, maybe even beyond just this year, especially if this recession goes, who knows how long it goes. So what happens if you need a rate increase next year? As Rob was talking about, as Cheryl was talking about, as Brian was talking about, that's more uncertain than it was once upon a time 3 short months ago. And then you have these small commercial entities that maybe they'll never come back. maybe you're predominantly residential by meter count, but you have a little bit more reliance on those commercial accounts for revenues. And then you have the drought again, that's slowly creeping in. And then with what's going on in the marketplace with the equity markets, public pensions, that's a question mark as well. I mean, CalPERS is about the best managed there is, but, even they can't control what's going on Wall Street. So I think what you would expect the rating agencies to ask, certainly S&P, is, okay, fine, we get the context for this year. 2020, it is what it is. 2021, where do you go from here? Will you have to scale back rate adjustments? Will you have to dip into reserves to do things to help people that are suffering? And how long will that take to sort of get back to your baseline of your typical financial performance? And then in the bigger picture, your capital plan pretty much will be the main driver for what you need to do for rates. And your rates determine your financial health. If all of those things start to get deferred or compressed, well, 50% of your rating is the financial stuff, fair or unfair. Your financial capacity might be diminished. So I guess to put it into bigger context and to kind of close it out, in the public finance department across S&Ps, so this is like anything, the tax-backed, healthcare, higher ed, we have actually already done 678 rating actions since the pandemic began, 678. In the utility sector, we've done 32. So I think Brian can probably confirm this. Your deals, if you need to sell bonds, are still getting done. There is still, like, if you want to call it a flight to safety, people recognize, Wall Street had been calling you guys an essential service long before the word essential was a thing. And so there is still a great amount of confidence in this utility sector. That doesn't mean, though, that over the next couple of years, things could start to get pressured. So that's really where our focus is going to be when we sit down to talk to you. And so I guess with that, I'll turn it back over if there's any questions. But I just want to say that we have confidence in you, but low risk doesn't mean without risk.
Wonderful. Sorry, there's delay in the unmute. Thank you, Ted. And by the way, if there's one benefit of the pandemic, lawnmowers, babies, and dogs are not a distraction anymore. So, so if I may, I'm going to switch into some questions for the panel. I haven't seen from participants, but if anyone wants to write in a question, please feel free. Brian, if I may start with you. You served as CFO of MET, Las Vegas Valley Water, and had a short stay in Pasadena, et cetera. So we talk a lot from the retail agency side. Would you mind giving us some insight in the wholesale side? So from a wholesale customer, if you're MET or the water authority, you're relying on selling water. If you're, say, MODOC, you're more of an administrative agency supporting your member agencies. So what should they be looking at in this economic time, and how should they also be looking at their member agencies, i.e. the retail agencies?
There you are.
Yeah. So the wholesale perspective, I can tell you at Metropolitan, we were much more concerned about weather than anything else when it came to revenues. I think on the retail side, the issues and what we see are our clients, clients like Irvine Ranch Water District, Molten Miguel Water District, to a certain extent, who have rate structures that are, really resilient. I mean, you cover your fixed costs, you adapt better. There are a lot of agencies where, I've dealt with folks in the Las Vegas area that are really concerned about water sales. And you talk, as Ted talked about, income levels and impacts on your community. They're dealing with this and going to have to deal with it in a lot different way than you guys.
Great. Thank you, Brian. So Cheryl, we talked a lot about trying to, in these times, balance our books with making investments in infrastructure. So you as the steward of the financials, the owner of the purse, what sort of questions are you and conversations are you having with your colleagues down the hall in engineering how are you making decisions at this point in time based on your financial outlook?
Yeah, I mean, I think because we've got some fairly significant reserves, we're looking at this, frankly, as a time of opportunity to maybe be able to do some different investments. We're not really seeing it, part of I talked about our connection fees and the fact that we use connection fees to help pay for new capital. It's just not enough of a significant impact yet that it would really impact our capital program and some of the things that we're going to do. On the other side, we're taking a look to see if there are potential investments that we ought to be looking at. So we're looking at it as a time perhaps of opportunity.
Fantastic. Charlie, I have a question for you. Since you're the one reaching out to everyone, I think we have a couple engineering consultants on the line, Jan, Brian, et cetera. So what's your guidance to the private sector as they support us in the public sector? How do they help Cheryl, myself, other members of a utility convince the board that it's the right thing to do moving forward in the projects?
Well, I think the answer that I'm getting, and frankly, probably to their chagrin, what I'm actually hearing from the engineering and the construction community is that actually things are really good right now because they're needed. And as was highlighted by a couple of you is, this is that dichotomy that we're going to deal with. Economic recovery, whether it's V, W, U, whatever it happens to be, it's going to be in the expenditure of public dollars, and there is no better place to do economic recovery than in public infrastructure. As Ted and all of you have highlighted, folks are looking at the water wastewater sector. There is still a very, I won't call it a heavy hand, let's call it a strong, firm hand to the back in California to continue to meet very stringent environmental and climate change goals.
Right.
And the state clearly recognized that as a path forward. So for those that are in the private sector that are actually looking to their public sector partners, it is a good time, but obviously you want to walk through the door understanding that it's not an open checkbook. This is not just throw money at the wall like you may get the perception of the federal government. It used to be we talked about, hey, $1 billion means something at the federal level. Well, now it doesn't mean anything until you get to $1 trillion. So it's a different order of magnitude. But I think your partners in the private sector really truly are partners. And together in that collaborative process, what we're seeing is that is part of the path out of this.
And so Charlie, let me ask you a follow-on question, and then Ted, I'll finish with one for you. So, I'm a water guy. It's just, I'm proud to be so, and we've moved from water and wastewater being separate ideas to one water. But what we do doesn't end with just water pipes and treatment plants. It really crosses over to transportation, stormwater, city governments, county governments, et cetera. So how do we have that cross collaboration with our peers across the aisle?
Well, I selfishly, and I put my rose-colored glasses, it's through coalitions like this. In the last week and a half, I have been invited by the state, by Stanford University, by Los Angeles County, both on the private and the public sector, to be a part of their economic recovery teams, being able to highlight where is that cross-functionality. I will highlight for you here, the Los Angeles Department of Public Works, the County Department of Public Works, Mark Pastrella, has taken the very challenging issue of the pandemic in LA County, which is really kind of the hotbed, but he's taken hold of that in the name of Public Works and brought together separate leadership teams that bring in hospitals, that bring in roads, that bring in transit, that bring in water, that bring in all of the various aspects that touch on public works. So it's not just my narrow silo. And he's really broadened that into a leadership group for LA County because they understand and they're moving forward on, as you just described, that interactivity between the two. We don't operate in a silo. We are part of a larger community. We have something to contribute, but that shared services and that dialogue becomes important. And that's sometimes what we leave out is the important element, which we started this entire series on, was communication. You have to do things a little bit differently. And part of that is over communicating with your employees, with your constituents, and with your allied government agencies.
Absolutely. And I saw Rob Hunter chimed in, just sharing the differences in perspective, just being, the different type of agency that MODOC is compared to MET. And that truly is the case. And so Ted, for you, so Brian highlighted some of the opportunities, and Cheryl as well. We have WIFIA, which came out of the TIFIA program. As you look at these regionalization, these projects that cross agencies, how do we come to you and pitch those? How are you looking at that from an individual agency or maybe for multiple agencies? What guidance can you give us?
So I think one of the things that we recognize is that there's obviously economies of scale. And I don't say that just as like throwing away an engineering term or an economist type of a term. It just makes sense because, I mean, you have maybe built out communities or communities that maybe don't have the deep bench of technical or ancillary services to be able to go out on their own. Maybe you just don't have the physical space to put something. So it certainly makes sense just from like a macro policy standpoint. I think one of the things that we look at when you have any kind of like JPA, Joint Powers Agency, is ultimately there's going to be contractual relationships that sort of glue everybody together. So from a rating approach, we will look at what happens if one community, like now is a great example, like one community might be suffering from a financial perspective, and maybe they're just like that late payer, like you've got 40 communities and you've got 39 of them that pay everything on time and in full to the JPA, but there's that one that's a little bit of a laggard. Well, bondholders don't really like getting 99 cents on the dollar. They like to get the full dollar on time and in full. And one of the things that will determine timeliness and fullness of payment are those contractual relationships like purchase water agreements. Maybe there's the ability for the agency to reallocate revenues, even on a limited basis, like maybe no more than like 25% increase or something in the case that you've got a delinquent payer. So, I mean, from a financial perspective, that's what we're ultimately looking at. From an operational perspective, I mean, those things usually just, they just make logical sense. Well, okay, fine. Yeah, you're moving water from Northern California to Southern California because that's where the water is and where the water isn't. Okay, well, that makes sense. And, do you address things like seismic risk and evapotranspiration and, pumping and storage, et cetera? Like all of those things are very readily explainable to a rating committee. And generally, as long as you've done your due diligence across the board on the operational stuff and the financial stuff, generally speaking, I can't think of a single one that would be speculative grade. Generally, those are well into investment grade.
Wonderful. Thank you.
Rob, this is Charlie, but before we go on, just want to interject just for a second, because like all of these forums, we like to learn as we go along. And as we design these things to run an hour, I know that we're running up against our hour, but because this is an important conversation, I want to ask the indulgence, both the audience and to the panelists, if you're in agreement, if we can go an extra 15 minutes, because I know that this is a good conversation. I want to be able to do that.
Wonderful.
Not seeing any thumbs down, so it's back to you, Mr. Grantham.
Oh, wonderful. Well, so in terms of those that have not grown up in the bond market, there's a term of art, and it's called a story bond. And so it is what it sounds like. I need to tell Ted a story in order to get the appropriate rating. My dog ate my credit card. My cat died. My brother took my credit card, went on a shopping spree. So, but I'm going to be okay. But one of the questions, and let me start with you, Brian, since you're guiding us. One of the things that we're doing right now is we look at the sizing of our bonds. Do we issue a larger bond and do it in one tranche? Do we do multiple tranches? And so under Brian's leadership with Darren and those at PFM, we're doing what's called stress testing. One of the things that I promised Ted, it's the remotest of possibilities, that there's no probability, I promise. But what happens if our property taxes somehow goes away? Don't listen to what I'm saying, please plug your ears. But how do we deal with that in terms of either a financial forecasting and then a reactionary mode? And so, Brian, what guidance do you have for agencies in general that could have certain segments of their revenues swiped out from underneath them?
Yeah, I think that's a great question. It is one of those stress tests that we look at. In addition to property taxes here, one of our clients actually received sales taxes and lost a lot of sales tax, a lot of connection fees. And so what we did is we ran scenarios and different scenarios. If they recover in 1 year, 2 years, 3 years, what impacts those have, so that you can show what your plan of recovery is and what actions you would take. And I think it's important to have a plan. And Ted can chime in here, but it's important to have a plan you can point to signposts and to actions that you have taken in order to address those kind of revenue hits, those kind of one-time hits. Losing, a good portion of revenues is never a good thing. And Ted said, hey, we're looking at this 1 year, as long as you have a plan, what is it going to look like next year, the year after, and the year after that? I would contrast that, by the way, with a typical story bond. The way we think of story bonds, they're bonds that are a little more complicated and they're unusual. And so you have to tell the story, but they still can be really good credits.
Okay. Thank you for that qualifier. Ted, if you don't mind expanding on, as Brian noted, and also what you talked about in your presentation, how do agencies deal with those sudden changes in revenues, whether loss of property taxes or otherwise?
Yeah, I think you always have to have a backup plan, and I think Brian hit it right on the head. I think one of the things that we would generally characterize as favorable for your credit rating is not just having maybe like a long-term financial plan, but almost if you want to have like scenarios of like, all right, well, scenario A didn't quite work out, scenario B, for example. And a very public example is City of Atlanta. They've been dealing with a consent decree for a long time. They have relatively pretty high rates if you look at their typical rate schedule. But they are being supplemented in their capital plan by a local option sales tax. It gets voter approved. Generally, I think the authorization is 8 to 10 years at a time. They're not legally allowed to pledge that for the benefit of the bondholders, but they can use that for pretty substantial pay-as-you-go. And they have represented, every time they go out for a bond election, they're not allowed, like anyone, they're not allowed to advocate, but they can certainly educate the electorate of, well, if we don't have this extended, we would have to do probably a one-time rate adjustment in the neighborhood of like, I think it was like 20 to 30%. And that's just an estimate. I'm shooting from the hip a bit. Right. But at least they've gone through and said, well, all right, well, okay, fine. We've figured out, like, if that particular revenue stream goes away and it is substantial, what would we have to do? And internally, I have no doubt that they have very well delineated and detailed prioritization of their capital plan. Fortunately for them, they're starting to get to a point where their mandatory CapEx is starting to become a lesser percentage of total spend. Not everybody's in that same boat. Some people have certain things they just have to do. So, it might just be like, yeah, my backup plan is to talk to the state environmental body, the DOJ, EPA, and say, yeah, that consent decree that I have that you wanted me to finish by 2025, can I have until like 2028 just to smooth it out a little bit, extend it because I'm on a revenue crunch. Another example would be the city of New Orleans. They were in the middle of a consent decree when Katrina hit. Right. And their underground infrastructure was already deficient, very publicly acknowledged deficient before Katrina. They were making some progress towards that, but it was like delayed because, the flooding and the damage and the outmigration of population. Right. They did have that conversation. They did, have a collaborative effort with the environmental regulators. So those are just examples of, all right, fine, yes, you're on this linear path, but what happens if there is a left turn? And I think that generally will give great comfort to the rating agencies that you've at least thought about it, as opposed to like shrugging your shoulders and going, I don't know, I'm going to go buy lottery tickets.
Right. Yeah, no, and Rob Hunter's on the phone and can speak very closely to that item. And Yvette, trying to marshal New Orleans through right now, she's struggling at this point in time. Cheryl, if I may ask you a question. So you have a great relationship with Paul Cook and your great collaborators, and the same thing with your board members. How are you communicating, whether to Paul, to your other colleagues, into the board in terms of what your plan of action is? You said you have reserves, but how have you changed in these past 2 months, and what do you foresee as trigger points in the future?
Yeah, I mean, those are great questions. Communication obviously is the key. So Paul and I talk all the time.
Right.
Both of us are in the office almost every day and working as opposed to working from home, just because I think it's easier. But it's communicating with your board, letting them know what's going on. We still have our monthly finance committee meetings. We have board meetings every two weeks, even though they're all done remotely. So it's really communicating and putting together a plan. We're really taking a look at, our reserves. What are our reserves? What are they looking like? And how is this pandemic really impacting more on the, on the capital side or on the rate side? And I think we have sufficient reserves. And in fact, last month at our S&P committee, one of the things that we did was we went through an analysis of what the potential impact to our reserves is. And they had to make a decision as to whether or not they were willing to not put through that rate increase. And like I said, we took it first to the committee and then we went to the board. And, the whole is for us, again, just because of where we're located, is not as significant as what other people from other cities or counties are experiencing, which is, you talked about it before in terms of affordability. If you're in the Inland Empire, you might be experiencing more impact from revenues coming in than what we're experiencing. But it's still a hole. I mean, it's still a hole. Like I said, we're going to defer our rate increase, postpone it. We'll see what the economy looks like, but it's really about constant communicating. And we haven't changed a lot. We're running a lot of, doing a lot of economic modeling, a lot of what ifs, what happens if the 1% goes away, et cetera. So we know, and it's all about having a plan and having a backup plan. And we communicate that regularly to our committees.
Wonderful. Well, if anyone's still on the line and from the Inland Empire, Los Angeles County, and has any comments on what you're doing, please feel free to share, and we can share with this group. And so let me ask this question of Ted and Brian. So special districts versus city and counties. And so some of our colleagues across the aisle and cities, they've lost the sales tax revenues. And Ted, in your presentation, you talked about we have the downside of 218, but we have the positives as well. How are you, what guidance do you have for, say, the cities out there that oftentimes even the enterprise funds are, hey, we're all in this together, we're going to take a hit as well. So what's your guidance for cities and counties? And Brian, same thing to you.
So I would end up in pinstripes if I did policy advice or structuring.
I understand.
But I would generally say that, maybe I can spin it this way. What we have seen among the utilities that are generally seeing rating stability, financial stability, yes, I mean, there are certain things that you can't avoid, whether it's revenue shortfalls because of disconnects and shutoffs, moratoriums, or just, people suffering, or because your decision-making body has said, this is not the right time to ask of a rate increase for our customers. And so I think one of the things that we will continually look at that it's maybe harder to measure, but easy to observe, and we know that it's important for credit quality, is we look at some of the operational things like, all right, well, tell me about your lost water percentage and age of meters and just the general characteristics of your distribution system and the underground, infrastructure on the collection side as well. And, are there SSO, I guess where I'm going with all of that is, if you can get by for another year or two and be just fine, as opposed to like run to fail, then, you know, I mean, that there's observable evidence that you're seeing deferral of infrastructure actually presenting itself with operational deficiencies, because we all know the truism of, you know, sort of pay for it now or pay for it later. But if you pay for it later for the same thing, there's going to be, you know, the cost plus some escalator for waiting on it. And it could be worse when you wait on it. But if you can get by with like, yeah, you know what, our non-revenue water, you know, per M36, it's like 12%. I can go like another 2 or 3 years without the meter replacement program. So, I mean, I think one of the things that we will ask is not just tell me about your capital plan and how you're planning to pay for it, but is it well prioritized? Do you have that discretion to just say, I don't need to do this now. It would be great if I could, but this will free up 400,000 here and 750,000 there. And then all of a sudden, I don't need to ask that rate adjustment from our board, and we'll be okay.
Yeah, and I think that the only thing I'd add to that, Robin, is that working in a city versus a district, you know, the advice Ted had and there, you know, applies to all utilities. And in the city, you're subject to, well, the other departments are doing this, so you're going to have to do it too. And whether that's looking at deferring salary increases, furloughs, and to Ted's point, it's how do those actions impact your ongoing operations? And how does your city council or your county board of supervisors understand that essential service and why it's so important? And do they apply the same things to you just because you're part of them versus what needs to happen? City councils are really reluctant to raise rates under the best of circumstances. So the question is, if we're deferring what kind of actions, what kind of signals are they sending for the next year? And what kind of actions do they have to take, and recognize that those utility departments are a little different than the library.
I think that's an exceptional point. Appreciate you noting it. It's interesting, you go back, S&P, Fitch, Moody's, a couple of decades ago almost at this point, and looking at the willingness of elected officials to make hard decisions. It's part of the criteria that we're looking at, the business management practices of a utility. So I really appreciate that. With that, let me ask each of the panelists, do you have anything else that you'd like to share for the benefit of the audience? Brian, since you're up, I'll start with you, sir.
I think this has been helpful to me, just hearing from you all. And, you know, even though we work together, it's just the different actions that we take now, and how we take, I love Cheryl's comment, how we take advantage of this situation to make our organizations better. This is a grand opportunity to work together, to work with your bargaining units, to work with your boards, and work with your customers to make your utility better.
Cheryl?
No, I mean, I thank everyone, and I think all the presentations were great, and I learned some things, and that's good. But again, this is all about communicating, and we are in an unprecedented times. Everyone continues to use that word, but we are. And it's really not only about communicating with your board and with your colleagues, but it's also about communicating with your employees and letting them know what's going on. They're nervous. They're nervous about coming back to work. They don't know. There's just so many unknowns, and I think when they do start coming back to work, it's gonna be different. It will be a different work environment. I think some will come back part-time, and I think people have to be prepared for that. I think people are going to be wearing masks when they come back into the office. The timing of that is unknown. I know we have weekly manager meetings just to talk with the top 45 people within our agency to let the managers know. I think it gives them some comfort. They can ask questions of the general manager. But it's all about planning and planning what to do. Are you going to take temperatures when people come back? But so it's communicating with your board, with your colleagues, and most of all, communicating with your employees so that they feel comfortable and feel like they know what's going on.
Thank you. I think that's an exceptional point. And Ted, how about yourself?
Well, I mean, I guess first of all, I want to thank you all for having me. I hope everyone on the line, you and your loved ones are well and safe. I would just maybe close with one thought that it was mentioned at the outset that S&P has a negative view of the sector. And I think that's the context of that is we don't downgrade for the sake of downgrading. One of the criticisms, if you will, of rating agencies is, oh, well, you guys are reactive. I would say that we kind of have to be. I'm not going to, the negative outlook is, okay, yes, you do have a rating. The rating has an outlook of where does S&P think that your rating is going to go over the next 2 years. That doesn't mean that I'm going to change your rating into a negative outlook. It just means that we're bearish on the sector for the obvious reasons of what's going on the front page of the world. But we're still taking things on a community by community basis. We're still being very deliberate because not everybody is suffering the same way. There was a major city here in Texas I just spoke to a couple of days ago. Their consumption year over year is actually up. I think they even tried to do a weather normalization, and their collections are pretty much spot on. Haven't seen much of a drop off at all. We've heard other communities 10, 15% down. So for me to make sort of like a broad brush, oh, well, negative outlook, downgrade, that's not the way we roll. We're going to still talk to you, be very deliberate about it, and get your side of the story. And again, where do things go from here? A one-off year does not a trend make. It's like the bigger picture, longer term.
And thank you for that comment. I think that's very meaningful for us on the utility side of the line. And with that, I just want to thank you three as the panelists. Exceptional job, great information. I learned a lot, as I always do with talking with you three. It's always wonderful seeing you. And then Nicoletta and Lynn, thank you very much for coordinating and keeping me on track. And Charlie, thank you very much for this vehicle to have the conversation. And with that, I'll turn it back to you for the close.
You're welcome, Rob, and thank you all again for participating. I think obviously this conversation, like the previous two that we have had, highlights the importance of a balanced approach to what is a very new, different environment, that not always looking in that rearview mirror gives us the kind of forward-looking that we need, and the creativity and the sharing is important. So I want to thank you for that sharing today. I also want to say, as part of our series, we learn as we go. And so June the 11th was the next in our sequence, and we've rejiggered just a little bit. And based upon the conversations that we have had, we're actually going to do a History Matters. We will have Tim Quinn, who has some 45 plus years in the water business and is now affiliated at the Stanford Law School. And we were talking about the need for looking at historical ways of solving some of California's most vexing water problems. We were very close, as an example, on voluntary agreements around the Sacramento Bay Delta, and that all came apart in some partisan politics, and now we're all sort of warred up and suing each other. So we're going to pick Tim's brain about how do you really truly get down, dirty, and solve problems, as opposed to some of the political posturing and some of the warmongering that we're sort of seeing within the industry these days. And I think that's going to be a really valuable conversation for us to have. And again, you can take that and push it down into these conversations as we look at our own integrated resource planning. What does that mean with the state and the feds? And what does that mean for our investment locally? What does that mean then and the impact on rates, and how we're going to then come through and then out of this pandemic? So I think a very valuable conversation in a couple of weeks. And so with that, again, I want to thank our sponsors again, Rich Nagel and Tetra Tech, for today, our usual list of founding sponsors, which I opened with. And I just want to say thank you to all of you for being with us. This again will be posted on our website in the next couple of days, so you can share this with other friends and others to gain perspective. And together, I will simply share through the Southern California Water Coalition, we're working with you to make our communities a better place to live, work, and to play. Thank you all for being with us. We'll see you again in June, on June the 11th.
Thank you, Charlie.
Thanks.